Hello and welcome. My name is Sean Hagan, and I am a senior non-resident fellow at the Peterson Institute for International Economics. We are delighted to be hosting a discussion of the recently published IMF paper entitled Policy Options for Supporting and Restructuring Firms Hit by the COVID-19 Crisis. As we all know, in response to the COVID-19, there has been an unprecedented level of policy support for firms, particularly small and medium enterprises. Countries now face a difficult dilemma. If they continue to provide untargeted support, there is a growing risk of what is generally referred to as the zombification of the corporate sector. On the other hand, however, a sudden withdrawal of support risks triggering widespread liquidations, which could also have a knock-on effect on the banking system and financial stability. Drawing on past experience, the IMF paper provides advice to countries on how they should navigate this transition from indiscriminate support programs to targeted support, with specific guidance on how the insolvency system, both the formal and out-of-court system, can support the corporate restructuring process. And I would note that the guidance set forth in this paper will inform the advice that staff provides in the context of both IMF surveillance and programs supported by fund resources. We are really fortunate that two authors of the report are with us to present its findings: Emmanuel Kopp, senior economist at the Strategy, Policy, and Review Department in the IMF. Emmanuel's research covers macro financial risk, financial stability and regulation, investment, and macroeconomic forecasting. Jose Garrido, who is senior consulting counsel in the legal department at the IMF. Jose is the supervisor of all of the insolvency work that's done at the IMF and provides advice not only to member countries, but also has contributed to the development of international standards in this area, a real intellectual leader in this space. Emmanuel and Jose's presentation will be followed by commentary provided by two discussants who have a real wealth of experience in this area. Christine Høeg Omdal, Deputy Director General at the Norwegian Ministry of Finance. During the COVID-19 crisis, she was the head of the Crisis Task Force on Economic Measures in the Ministry of Finance, and also the chief coordinator for the design and development of two of Norway's key economic support measures, a fixed compensation scheme and wage support scheme. The second discussant will be my colleague, Patrick Honohan, who is senior non-resident fellow at the Peterson Institute. Patrick was governor of the Central Bank of Ireland and a member of the Governing Council of the European Central Bank from September 2019 to November 2015. Following this commentary, we will open this up to questions from all participants. Please use the Q&A function as the event unfolds. Emmanuel and Jose, over to you.
Good morning also from our side. Thank you, Sean, for the introduction. So we are going to talk about our departmental paper that was published yesterday. It's joint work with Juliana Araujo, Jose Garrido, Richard Verghese, and Wei-Shi Yao. So as Sean has said already, the COVID-19 pandemic led governments to take unprecedented policy measures to stop the spread of the virus. Lockdowns, shutdowns, mobility restrictions, and so on brought many economies to a sudden stop. Income was lost across industries, but liabilities and commitments remained, which put significant liquidity pressure on the enterprise sector at a time when, concerns about corporate leverage were already high. So in the initial phase of the crisis, countries deployed broad-based containment measures, including freezes of insolvency proceedings and largely unprecedented monetary and financial support to keep companies afloat. In the initial crisis, which we call freeze, in the initial phase, which we call freeze phase, the immediate policy response favored speed over precision, given large uncertainties about the impact and the duration of the shock. So most countries, but not all, are now in what we call the transition phase. During that phase, government support may still be needed, including because of recurring waves of the virus, as we've seen with Omicron. However, government support should eventually become significantly more targeted. What does that mean? It means that support is extended to viable firms, which are firms where the going concern value is higher than the liquidation value. The idea here is to avoid risks of zombification and a more efficient use of scarce public resources. Policymakers will also need to stand ready to help with the restructuring of the corporate sector and facilitate also the exit of non-viable firms and the entry of new firms that are typically more productive. Also, it is important to keep in mind that lenders, particularly banks, need to support the recovery of the enterprise sector. And that is a very essential element of the transition to a, let's say, new economy. However, just like any other crisis, this crisis will leave its mark on the financial sector as lenders increasingly absorb credit losses. This problem will become even more relevant as governments withdraw public support and the extent of the damage becomes visible. Here, it is very important that bank balance sheets remain sound and also transparent. We have had like 2 years of regulatory forbearance, which was orchestrated and typically in line with the regulatory framework. So the flexibility built into the frameworks has been used. But the consequence is that there is not a lot of clarity about the actual credit risk in banks' books. Here, we think that also, increasing the transparency will be important, and it's also, and one of the most useful tools here is particularly the asset quality reviews that can be done to arrive at a baseline for assessment. Also, a very important point here is that we shouldn't forget is that governments have taken a very important role in this crisis by supporting enterprises. So this means that governments now have a more expanded role beyond what is typically considered government issues. So essentially, the government has become a venture capitalist in the enterprise sector. So one of the central elements of our paper is a comparison of corporate sector vulnerabilities and the crisis preparedness of countries' insolvency systems. Let's have a look at that. So interestingly, corporate insolvencies remained relatively low, but debt has increased, particularly for emerging market economies. As of end 2020, the debt of non-financial firms in emerging market countries has increased to over 110%, and is now higher than in emerging countries. So what we see is, a low number of insolvency cases, but higher debt. So here on this slide, you see our new indicator for crisis preparedness. What does that do? That indicator is designed to measure the preparedness of countries' insolvency systems to address large corporate debt crises. The indicator has 5 dimensions that are, known to be highly relevant, especially during crises. Out-of-court restructuring are essentially principles, mechanisms, and incentives to kind of foster informal negotiations between the debtors and the creditors. Hybrid restructuring is supported by limited court intervention, and the rest is informal. Reorganization is a procedure to perform financial and operational restructuring, including the treatment of contracts. Liquidation refers to flexible and fast procedures to minimize creditor damage, including by allowing the sale of the business. The institutional framework is also known to be particularly important for the effectiveness of the insolvency system. Here you need specialized judges, digitalized courts, and proper regimes for insolvency administrators. So, and again, these 5 areas reflect aspects of the international standard that are typically especially relevant during corporate debt crisis. In the chart on the right, you see something that is not particularly surprising, which is that advanced economies tend to score better in that index simply because they have more options beyond the full formal insolvency framework to deal with the cases, and they typically also have stronger institutions. Emerging markets are somewhere in the middle, and in low-income countries, we do see significant shortcomings in various measures. Now let's bring that together. On the chart on the left, essentially, that's just a geographical illustration of how well prepared countries are. The darker the shade, the better countries' preparedness. And here you can see that there is also significant variation within the same income groups. That means not all emerging markets score lower. In the chart on the right, we plot the crisis preparedness indicator against non-performing loans. And here we can see a similar picture where the low-income countries have typically not well prepared and have a high share of NPLs. So this is unfortunate because it seems that those countries that seem to be less well prepared than others also deal with a higher level, higher share of non-performing loans. So let's now have a brief look at support policies. So clearly, there are important trade-offs when it comes to considering public support for the enterprise sector. As Sean has convincingly illustrated in the beginning, prolonging untargeted support clearly risks further zombification of firms. And it also exhausts policy space that could be used much more efficiently. The problem with zombies is that they weigh on economic performance, they are less productive, they lead to lower investment and employment, and also stifle the entry of new firms. So clearly you do not want further zombification of the enterprise sector. Here in that graphic, you can see that feasible policy options vary according to countries' fiscal space and the capacity of the insolvency framework. Clearly, there are also other factors playing into this, but these are 2 of the main, of the key determinants of the design of policy support. So countries that have more fiscal space, more remaining fiscal space after these 2 years, and effective insolvency system have a pretty rich set of options, including the possibility to provide additional financial support. So continuing the support programs, for instance, through continued liquidity supply, but also equity injections, solvency support. Or they can resort to more market-driven resolution of debt restructuring. So essentially, the choice between targeted support and restructuring should consider the nature of the firm's difficulties. If the difficulties are judged as merely temporary, firms should be supported. If the business models are put into question, for instance, because the structure of the economy has changed and the circumstances have changed, it is important to address these firms, and restructuring becomes essential. So although like full formal judicial reforms take time, deploying out-of-court and hybrid solutions for the restructuring of that can support quite quickly the formal insolvency process. Countries with weak insolvency systems need to rely much more on out-of-court workouts, which is what we argue in the paper. Among these countries, those with remaining fiscal space have the option to provide further support and incentivize restructuring while implementing legal and institutional reforms. And clearly, countries with ineffective insolvency systems are at a significantly higher risk of slow debt resolution. So from our analysis of several past crises as well as the current crisis, we came up with a few principles for designing public support schemes. Clearly, any public intervention in the private sector requires clear objectives as to which market failures are addressed. The most obvious market failure here is that insolvency system may be overburdened by a high caseload, and this is the market failure that is typically addressed. Another market failure is that due to high uncertainty, creditors are no longer willing to provide liquidity and equity support. Second, conditional debt relief can incentivize resolution and burden sharing. However, unconditional debt relief typically doesn't work well. It creates not the right incentives and has in the past not worked particularly well. Institutional frameworks are key for successful progress. So, and we shouldn't underestimate that point. So there's also institutions in countries that typically have extremely good public administration that struggle with administering programs. So this is not a trivial point. Institutions are very important. And also, given the size and the dimension of the support that has been extended, safeguards will be needed. So, and we argue that public intervention should be based on transparent criteria. So firms should know what they are entering. Then policies should be designed to mitigate risks to growth and financial stability, should focus on viable firms distressed due to the pandemic, and support programs should be time-bound and include a clear exit strategy. Let me now hand over, please, to Jose, who will talk about the restructuring and insolvency. Thank you.
Thank you so much, Emmanuel. Let's look now at some aspects of restructuring and insolvency. First of all, support programs cannot and should not avoid enterprise failure. Enterprise failure is an integral part of any competitive market economy. So the reduction of cases that you saw before is temporary. With rising debt levels and structural transformations, insolvency levels will pick up. Now, the legal system has a dual role. It needs to provide tools to return firms to viability and also liquidate non-viable firms so that assets are reallocated to more productive uses, the classic creative distraction. So the legal system needs to include a toolbox that allows economic operators to deal with multiple situations of firm distress. Now, the diagram here, you can see the tools to tackle corporate debt distress from those that are purely informal to those that require intense judicial involvement in the shape of formal insolvency procedures. Now, we will get to this later, but what is important to emphasize is that each country needs to perform a gap analysis and then reinforce the system in the required areas. Now, the analysis in our paper is based on the fund's experience in crisis. In fact, most of the points that we make are based on cumulative lessons learned in past corporate debt crises. And we can start, for instance, with the tequila crisis. And it was very clear that bank supervision, it's a fundamental factor, that there's a need to incentivize restructurings. And also, it was apparent that insolvency systems needed to play a role, and robust institutions are absolutely essential. In the Asian financial crisis, one of the biggest corporate debt crises in history, corporate restructuring became essential for economic recovery after the recapitalization of the financial sector. And out-of-court restructuring was a major factor in the resolution of the crisis because it served to address the ineffective formal insolvency regimes. The global financial crisis brought us a bailout of large strategic companies. You may recall what happened with the automobile industry. But in general, there was a large number of insolvencies that overwhelmed the courts in many countries, and this resulted in excess liquidations. Finally, the European crisis in 2012 and later showed us the different aspects of the problem, like the risks of zombification, and also that it takes a long time to resolve legacy non-performing loans. Because of the challenges with out-of-court restructuring in many European legal systems, this is where hybrid restructuring became popular. Let's consider now the restructuring techniques that can be of assistance in this crisis. So both out-of-court and hybrid restructurings are good alternatives to avoid overwhelming the courts. On the one hand, out-of-court restructuring, informal restructuring, can be enhanced by different means, like providing administrative support, issuing guidelines, having master agreements that bind participants, and generally using what we call sticks and carrots, so incentives and disincentives for participants to reach agreements. SME restructuring benefits from a more streamlined approach, like based on codes of conduct, using standardized frameworks with standardized outcomes, and providing support and assistance to debtors who don't have the necessary resources to prepare business plans, for instance. In any case, out-of-court restructuring is much easier to scale up and down than changes in the formal insolvency system. On the other hand, hybrid restructuring also facilitates restructuring activities thanks to the limited court intervention. So because court intervention is limited, this allows for a better rationalization of court resources and also for the prioritization of complex cases. And as we've made this point several times, the good thing about out-of-court and hybrid restructuring mechanisms is that they can be deployed as a quick reaction to a crisis before reforms of insolvency framework take effect. On insolvency regimes, some essential points to consider. Reorganization is absolutely necessary when deep operational and financial restructuring is needed. If what is necessary for a company is to change the capital structure, to downsize the workforce, to change suppliers, to do that, it's absolutely necessary to have a really complex set of tools that include stay of creditor actions, rules for executory contracts, deep financing, and mechanisms for approval of plans. Now, this sophisticated mechanism may be too much for smaller enterprises, so there's a trend to have smaller enterprises subjected to a simplified regime. For liquidation, most important thing is that it needs to be swift and it needs to be flexible. And allowing for going concern sales is extremely important because that minimizes destruction of value. The institutional framework needs to be anchored mostly on the specialized judiciary. A specialized judiciary makes the big difference, but it's also important to have an ecosystem of insolvency professionals and financial and legal experts. And some change that is being introduced is the increasing use of technology that we see, for instance, in sale platforms, e-auction systems, and electronic procedures. And as Emmanuel said before, states are going to have a major role in this crisis because they are one of the main creditors. It's not only, as usual, that they are creditors for taxes and social security contributions. It's the result of all of these support programs based on loans and guarantees. So states are going to have to cooperate with the financial sector and benefit from their expertise in finding restructuring solutions and seeking to preserve viable business by providing incentives to that activity. So to conclude, I think we are seeing increasingly targeted support, and this is the right way to structure this support with the conditions that were mentioned for the successful implementation. But in any case, the withdrawal of untargeted support is going to put pressure on firms, particularly in emerging market economies and low-income countries. And countries should prepare for an increase in restructuring and insolvency activity. And every country has different challenges. Every country has different areas to address, but there are some common points. And I think advanced economies really need to focus on targeted reforms, like special procedures for small businesses or the increased use of technologies. And emerging markets need to expand options to restructure firms, perhaps improve also institutional frameworks. And for low-income countries, there's a real need for broader insolvency reforms. And both in the emerging markets and the low-income countries, it's possible to focus on out-of-court and hybrid restructuring while these broader reforms take effect. While doing all of this, countries should keep an eye on the banking system and make sure that the banking systems remain sound because losses will eventually materialize. So thank you so much for your attention and looking forward to your comments and questions, and back to you, Sean.
Thank you, Jose. Thank you, Emmanuel, for that very interesting presentation. There are a lot of issues there that we can discuss. And to that end, I'm going to ask our discussants, perhaps first, Christine, if you would like to offer some remarks, and then followed by Patrick.
Yes, thank you very much. I'm very glad to be given this opportunity to comment on this paper and give some reflections on economic policy measures towards firms during this crisis. So in my comment, I will share some thoughts and experiences from our work with support schemes in Norway and what type of support we provided to firms. So countries chose different crisis responses depending on their initial economic and financial situation, and also their institutional framework, including how their social security system and legal systems are designed. During the crisis, the Norwegian government introduced many of the support measures towards firms that are mentioned in the article, but not all of them. For example, we did not provide equity to firms, and we provided loans only to some extent through a loan scheme with partial government guarantee. That was a system operated by private banks. But this was mainly used by the bigger firms in the early parts of the crisis. So instead, we focused primarily on giving direct support to firms in difficulties to cover fixed and variable costs. So the Nordic countries are known to have comprehensive social security systems. And as part of our ordinary system, we have a program for temporarily layoffs, a so-called furlough scheme, where the government can take over the wage cost of redundant workers when a firm gets into trouble. So this is a burden sharing system between firms, the state, and the workers. So through this system, firms can, with only a few days' notice, temporarily lay off workers and eliminate their wage costs. And then the state would step in to cover a substantial share of the wage. And during the crisis, they covered, or we covered, as much as up to 80% of the wage for low-income workers. So this system resembles the job retention schemes that many European countries introduced during the crisis. For us, this system was a very important part of our economic crisis response, and it was also heavily used by firms. So through this system, a large chunk of the variable cost of troubled firms were covered by the state. So that was one pillar of the coverage. And the other main pillar of our crisis management system towards firms was a new scheme developed at the beginning of the crisis to cover the fixed costs like electricity, interest rates, rents, etc. And the key criterion for support from this fixed cost compensation scheme was to have a turnover decline due to the pandemic. And the support was increasing with the turnover loss. So this type of subsidy can be viewed as solvency support. So it's sort of similar to injecting equity into the firm, but without gaining the ownership, with neither the potential future upturn relates to that, but more importantly, in our view, without the responsibilities that come with ownership. So with the combination of these two support schemes, the firms that were hit the most during the crisis, with more or less those that had more or less no activity due to this health containment measures, could get both wage costs and fixed costs covered by the states. It was sort of like putting them in the freezer while providing the means to defrost and open up again when the situation approved. We were, of course, concerned if this strategy would result in zombification and prevent necessary restructuring of firms. However, the experience was that activity bounced back for most of these firms the minute the health containment measures were removed. So let me go a little bit deeper into the cash compensation scheme for fixed costs, which we regard as our main creative achievement during this crisis. And the fact that we would create a subsidy scheme to cover fixed costs as a crisis management tool was beyond our imagination prior to the pandemic. In general, economists, and particularly those at the Ministry of Finance, are quite reluctant to provide subsidies to firm owners get the gain in upturn, and they should also bear the cost in downturns. However, times were not normal. It was a strong sense of urgency and the fear that several businesses were on the verge of bankruptcy. In worst case, a systemic collapse with huge costs. And the pressure for financial aid was enormous from businesses, from business associations, and basically from all parts of the political society. And pressure increased even further when our neighboring country, Denmark, announced such a compensation scheme for fixed costs late March 2020. So when we announced the plan to develop this scheme, it was promised it would be up and running within 3 weeks. And the promise was kept. 3.5 weeks later, thousands of small and bigger companies got individualized cash transfers into their bank account. That was a record in developing advanced support schemes, at least in a Norwegian context. So at the time of developing this scheme, the uncertainty was enormous. We did not know the width and the depth of the crisis and how many would be in need of support. The simulations on historical accounting data suggested that as much as 20% of our companies would be in need of support, as many as 100,000 firms. Looking back, it was not that many in the end, but at the time we needed to prepare for such a mass. And we had neither the administrative capabilities nor the manpower to handle such a mass of applications. And therefore, we concluded early on that we needed to have an automated system to evaluate and control application and to initiate payments. But the potential workload could still be enormous if we had to revise applications at a later stage. Therefore, we needed to have control mechanisms so that we can have the control upfront, and also no conditions related to the future path of the economic situation of the firm that received support. We chose the Norwegian Tax Administration Agency to develop the technical solution and to operate this scheme in collaboration with also private banks. The tax administration benefited from their already very advanced IT knowledge, and they were also able to create an automated solution using pre-existing digital control measurement methods, using also data they had access to from tax reports and other registers for control mechanisms. An automated application handling system required the criteria for support to be clear, objective, and measurable, as was also pointed at by the IMF. It could absolutely not allow for discretion in the application handling. And normally, one, of course, would take time to analyze the problem, evaluate positive and negative effects, evaluate alternative solutions, and so on, but we did not have the time to do a full investigation when developing this scheme. So our assessment focused on the following elements. On the one hand, the solution had to be simple, efficient, and provide payments fast. On the other hand, the support needed to be targeted and accurate towards the particular firm. The possibility of misuse had to be as limited as possible. And last, the scheme needed to provide good, or at least not bad, incentives. A scheme that provides a high support for large losses bears the risk of incentivizing firms to shut down their business to maximize the support from the state. So basically, we needed to make sure that firms would always be better off if they increase their activity and their production, even though that would imply lower compensation from this scheme. I would also like to mention one particular feature of this scheme, and that was transparency about the support to each firm. So to receive a grant, the firm needed to approve that the financial data relevant for the application would be made public on a separate website. And this public register about the grants was actually extensively used by Norwegian newspapers and researchers to monitor the scheme, precisely as we had hoped for when we created this. So even though this was not a formal control measure or mechanism, it probably played a paramount role in compliance and also to avoid misuse of the scheme. So let me round off by turning to the exit. We have learned that when health containment measures are removed, activity quickly bounces back. And grants and compensation that are linked to turnover loss, in that sense, they phase themselves out by themselves when the situation improves. And in that sense, grants are easier to exit than direct ownership or loans. And further, grants do not require the same follow-ups as loans. You don't have to evaluate which loans to convert to equity or how to restructure the loans when that is necessary. But on the other hand, when leaning on grants like we did, a risk is that support is given to firms that quickly regain the loss in turnover, and that would be a waste of public money. I will not yet provide the verdict on what is the best strategy. That will be an interesting question for research going forward. Thank you very much.
Thank you, Christine, for sharing your experience. Patrick.
Thank you. This is a very important topic, and there's plenty of meat in this paper and valuable advice on the structures and approaches that are needed to deal with the post-pandemic debt restructuring situation, which is starting to materialize increasingly, I suppose, especially in emerging economies and developing economies. I'll just touch on a few points. First of all, on history, paper in particular, it gives a lot of attention to historical experience, as we saw from Jose's presentation, and while rightly noting that lessons from the past crises need to be adapted to the unique features of the current crisis. So that's my first point. Let's just say a few words about this. Often when I'm asked about debt restructuring, it's in the context of asset management companies, which have been so prominent in the resolution of banking crises over the past, well, few decades, but not least in Ireland. So how about asset management companies in the current situation? As I read it, the paper is rather cautious on these, and I think rightly so. It's worth remembering that some of the most widely cited success stories in AMC, asset management company debt restructuring, have been largely focused on real estate companies. And that's true of the Resolution Trust Corporation in the United States in the early 1990s, in the Securum and Retrieva in the Nordic banking crisis, more recently NAMA in Ireland, entirely a real estate loan recovery agency, and Sareb in Spain, largely the same thing. And this is a major difference with the debt restructuring challenges faced this time. Here we're talking about firms in other sectors, not in the real estate sector, including, for example, as everybody knows, hospitality and some parts of transportation, whose capital base has been eroded by a lengthy period of closure or reduced activity. So it's not just a question of realizing the value of a portfolio of real estate. Historic cases that don't involve such as a heavy real estate component are found in history as well, of course, in Asia, both after the East Asia crisis in Korea, Malaysia, and Thailand. And then they're mentioned actually in some very useful detailed annexes to the report, and in China following the reform of the big banks there around the turn of the millennium. I think it's fair to say that asset management companies such as Malaysia's Dana Harta, they didn't really do much operational restructuring of the firms which fell into its hands. It was more financial restructuring and sale of the business. If they had a business, and they said, well, okay, we'll sell it, and somebody else can do any operational restructuring that's needed. Operational restructuring was left to the private sector, though not to the banks in large part. All in all, I think it's best to see AMCs as a tool that can be used mainly in a situation where the banking system is operationally overwhelmed by non-performing loans. Debt restructuring is not something in which most banks have a comparative advantage in. That was certainly our experience in Ireland. And nor do the new AMCs, which are likely either to grow to substantial financial intermediaries on a semi-permanent basis, as I think has happened in China. Not necessarily bad, but it's maybe not what you expect when you start up. Or they will concentrate on passing on the operational restructuring to others. So to be sure, it's not clear how many of the over-indebted firms in this post-pandemic situation will need operational restructuring as distinct from financial restructuring. And here too, there's a contrast with the East Asia and other crisis cases. After all, the problems of corporate over-indebtedness in Asia at that time resulted, at least as it was interpreted, in large part from poorly managed firms or ill-conceived ventures. Whereas, as the IMF paper certainly points out, the pandemic has affected well-run firms, many of whom do not need operational restructuring. So the usual triage that you're going to carry out at the beginning of this exercise, as noted in the paper, between firms that are non-viable, those that are viable but need operational and financial restructuring, and those that are viable, needing only financial restructuring, is likely to be tilted much more than in the past to the last group. Especially where ex-ante support, such as Christine has described for Norway, has not been available. If it has been available, then great, you're out free, at least at this stage. Maybe you paid a lot for it, but you're out free at this stage in Norway and in many other advanced economies. So in a way, this part of the problem is thus a simpler question of the allocation of losses. And the IMF paper is absolutely right in focusing on streamlining the legal and policy mechanisms that allow this loss allocation to be resolved. And the recommendations in the paper are consistent with what has been said in the past, notably after the Asian crisis. And actually, the slide, the charts that Emmanuel put up showing that some lower income countries or countries that are not considered advanced economies are in good shape from the criteria. The ones that are in good shape, I had a quick look at them, and they are basically coming from East Asia or from Latin America. So this is a well-established principles and approaches. The emphasis that on what used to be called the London approach to out-of-court multi-creditor workouts seems exactly right. It's designed to give the time and information needed to get agreement on the way forward without creditors pushing and shoving to grab collateral and without debtors looting the firm's assets while negotiations are in progress. So that is a good principle, but it's hard to comply. It's hard to achieve compliance with those principles. I certainly agree that the state should be right there trying to ensure to remove unnecessary obstacles to these out-of-court restructurings. The supervisory agency of banks should be careful to ensure that its loan provisioning and capital adequacy rules are not tilted against out-of-court settlements. You always hear, the banks say we can't do this because it looks like a good deal, but the supervisor says it's not permitted. Oh, and we didn't understand what the supervisor. The supervisor has to be proactive in making sure that they are not putting obstacles in the way of that. And I also welcome the reference to the role of courts in enforcing pre-packaged deals on holdout creditors in the so-called hybrid restructurings. And that's proved to be an effective tool in many cases, including in Ireland in recent years. Now, I'm less sure about the suggestion that the state could promote compliance through tax incentives for debt restructuring, or by offering to accept higher haircuts for state claims, or other forms of solvency support are discussed. There's a big chapter 4, all about that sort of stuff. And that's why the reason I'm a little bit doubtful about it is that I see quite a risk that many powerful interests will be looking out for opportunities to turn a creditor position in a financial restructuring in a way of leveraging financial resources from the state. And this could easily become the main story in post-pandemic restructuring, rent seeking by participants in financial restructuring of over-indebted firms. And that's the nature of rent seeking. The jockeying for such advantage can often end up in delaying the restructuring process. The bigger the pot of public funds that seems to be available for this purpose, the longer the rent seekers will wait to increase their share of this pot. The IMF paper draws a distinction between countries in which fiscal space is depleted and those with remaining fiscal space, emphasizing that the latter, the ones with remaining fiscal space, have more options and can provide continued support to firms while implementing reforms. I would be a little less gung-ho about the concept of using the remaining fiscal space here, even acknowledging that the authors have stressed the importance of efficient and targeted use of such space. Certainly they've said that. But the fact is that all fiscal outlays have a social cost well in excess of the private benefit. Taxes are distorting. Other benefits can be other public spending that could be done, not going to be done because you've channeled the funds into this particular use. Certainly there are positive externalities or social benefits in avoiding inefficient bankruptcies. But I'm resistant to the idea that large-scale financial support of debt restructuring by the state should be given a free pass in budgetary planning. The pandemic has imposed heavy costs on most of society, and other resources devoted to debt restructuring will in the end compete with the financing of other public services. Public financial support of debt restructuring needs to avoid, as far as possible, deadweight transfers to creditors who can well absorb greater losses. And this is all the more so in environments where such decisions can be influenced in favor of politically connected persons. So maybe more emphasis on the fiscal disincentives than the fiscal incentives. Politics, both good and bad, will be at the center of this process. And as Katrine has suggested, transparency can help. Let me stop here.
So thank you, Patrick, for those provocative remarks, and it raises a number of issues. Perhaps I've seen one question in the line here that relates to, and I'm going to sort of direct this to Emmanuel, to the role of the IMF in providing financing for countries that are suffering from this transition, who are struggling with this. To what extent are there any IMF financing facilities that have both the maturity structure and the interest rates that are compatible with the types of problems that arise from this type of distress? And Emmanuel, after you answer that, perhaps we can then broaden it to some of the broader issues in the paper. Thank you.
Okay, thank you. So as you and many of the participants know, the IMF has taken a very active role in this crisis. One of the key measures, I would say, was the large SDR allocation, where countries were given significant financial means to address the health crisis. The idea here was certainly to give countries more firepower in combating the crisis. At the same time, at the fund, we've seen a significant and fast increase in the number of program requests, financial assistance requests, especially from smaller countries with less fiscal space. So many of the countries, or how should I say, the financing instruments vary across countries. There's not a single instrument that would be used, and it's always on a case-by-case basis. Also, the fund monitors its members on a very regular basis. We do the so-called Article 4 consultation every year. And one of the key things we have been looking at has been the measures countries have been taking to address the crisis, and also increasingly issues around exit from these policies. So countries have a lot of questions typically around, what to do going forward, how to make programs more targeted, when to start withdrawing support, whether to phase out the support or have more like a hard stop. So these are all extremely relevant issues in the recent past, and they come up with essentially every country consultation.
Okay, thank you, Emmanuel. So there's one other question that's coming up I want to look at, but I wouldn't mind if I can use my privilege as chair of this to ask a couple of questions, which I think are also raised by some of the remarks made by Patrick and Christine. I mean, the paper points out that essentially the assessment of viability, which is critical, whether or not a country is reorganized or liquidated, is a creditor-driven process. And the criterion normally is, which approach maximizes the creditor's claim most. In that regard, what role should the state play in this? I mean, is the state playing a role as a creditor? And if it is it using exclusively that criteria? Or is it looking at broader sort of political economy issues? And does this raise this problem of, to what extent do we want the state involved in picking winners and losers? And I think this is, this echoes the point that Patrick was making about the risks involved in the state becoming too actively involved. So that's one question. And the second one is on a very different topic, which is, I think the indicator that the IMF has come up with is very interesting. I would note, though, that it is, as I understand it, an assessment of corporate sector insolvency systems. And as the paper points out, a lot of the distress is in the small to medium enterprise. And many of those enterprises are not incorporated and therefore are subject to the household insolvency system. So I was wondering whether or not, and maybe Jose can respond to this, to what extent is the fund also looking at those issues? And I've now had a chance to look at the question that came up, and it's an interesting one. To what extent should policy support going forward also take into account decarbonization? Should this somehow be part of the conditionality imposed by countries as they're providing support. And I open this up, I guess, first to the presenters and then also, of course, to the discussants.
Thank you. Sean, if I may. So the viability analysis, the classic viability analysis is basically to determine whether the business is worth more alive than dead. So essentially it's a comparison of the projected future income with the present value of liquidating the assets. And as you say, that is typically creditor driven. It looks at creditor interest, but creditors' interests are actually aligned with the broader interest, because that way you keep alive only the businesses that are viable. Now, the point about the state is absolutely correct, that the state may always play a positive role, but it may also be negative. I think what we are saying in the paper is that sometimes the state basically keeps away from restructuring. And this is typical in tax authorities, social security authorities. They just wash their hands and let the other creditors decide, and they keep to their priorities and so on. Now, in this crisis, that's going to be increasingly difficult because the state is going to find itself as being probably the major creditor of a lot of these SMEs. And so the state needs to, cannot basically disengage. And what we suggest is, obviously, if there are professional creditors are going to be able to put together plans. And states should be supportive of those plans. That's more or less a general approach. But generally, there's a strong need for guidance on how a state is going to behave in these restructurings, because it won't be possible to stay away from them. On the very quick point on the AMCs are good for real estate because they are able to repackage real estate portfolios, sell them, and so on. They are also relatively good for large companies because they concentrate all the creditor positions. So they basically resolve a lot of the multi-creditor workout problem. But of course, that raises the question of political interference. Now, where AMCs don't have a good track record is with small and medium companies, because they are not prepared for that. And in small and medium companies, the cost of restructuring are probably higher, and there's not significant saving in cost by using an AMC. Finally, on the indicator indeed is focused on the corporate insolvency and corporate restructuring mechanisms, but we also have included elements that refer to SMEs. But you're absolutely right that there's an element that is not captured, and is what happens to the individual entrepreneur. And for that, we will need to do supplemental analysis, particularly basing it on the availability of a discharge for debt, so that it provides a fresh start to entrepreneurs, which should definitely integrate that. Thank you. I'll stop here.
Maybe if I could add on the difference between small firms and micro firms and very large firms. So essentially, for large firms, large corporates, the case is pretty simple. If equity markets can be accessed, or if the debt obligations can be restructured. So for them, we don't really see a big issue. However, if the firms are not listed, it's unlikely that the markets will provide the full amount of equity needed, and here governments may need to step in, as they did in the past. For unincorporated firms, like small firms, micro firms, the case is very different. How can you help them? They can't access the market. They may not be supported by many lenders. So what you can do is either provide grants, which was heavily used in Europe, including in Norway, or hybrid financing instruments. These are subordinated loans, profit participation loans. These instruments can also be important catalysts for private equity investment, typically because they come with higher transparency requirements. But yes, in terms of the corporate risk analysis, clearly one thing that we have learned is very similar to what happened 20 years ago with banks. is that we don't really have a good handle. There's no good data on small firms and micro firms. So it's very hard to assess risks in that segment of the enterprise sector. That's also why our corporate vulnerability analysis had to concentrate on those firms for which data was available. But clearly going forward, a very important topic will be to increase the transparency of smaller firms and get a better handle on that segment.
Okay, well, yeah, I think we've run out of time. We look forward to that further analysis on household insolvency, but thank you all very much. Unfortunately, we've run out of time. I want to thank our presenters and our discussants for this discussion. I've read the paper. It's a very stimulating one, and I encourage all of our participants to do so if they haven't already. Thank you all very much for participating, and good day.